Imagine you've spent years, maybe decades, building significant wealth. It's a legacy, right? Hard work, smart choices, maybe a little luck involved.
Definitely.
And now you want to protect it, nurture it, make sure it benefits the people, the causes you really care about for generations.
That's the goal.
But then you look at the rules, taxes, estate planning, how assets actually pass down, and it feels like this incredibly complex maze. It's constantly shifting.
And the stakes are huge.
Exactly. How do you even navigate that? How do you make sure your assets are safeguarded, directed where you want them, instead of, a big chunk just vanishing?
Yeah, unintended consequences, or just taxes eating away at it.
That's the big question. And that's really the core of what we're diving into today. We've got this stack of material articles, research, notes, all focused on advanced U.S. tax planning, specifically for high net worth individuals.
We're talking strategies that go way beyond just having a simple will or a basic living trust. This gets into sophisticated legal structures, intricate timing, strategies designed to hit multiple goals at once.
Right. So our mission here is to unpack these powerful, maybe sometimes daunting techniques, understand the concepts behind them, and really pull out the crucial insights you need to know about minimizing estate taxes, protecting assets, and making sure wealth transfers happen effectively according to your plan. It's a dynamic environment.
It really is. Okay, let's get into it.
Let's unpack this. Where do we start? What's the fundamental challenge here?
Well, the fundamental challenge, once you've accumulated substantial wealth, it really shifts.
Yeah.
It's less about accumulation and more about preservation and ensuring a smooth, efficient transfer across generations.
Efficient meaning less tax bite.
Exactly. You're facing potential federal gift tax during life, federal estate tax at death, possibly state-level versions of those too. And then there's the generation-skipping transfer tax, the GST tax.
Okay, GST tax. That's the one specifically designed for transfers way down the line, like to grandkids.
Precisely. It targets transfers to beneficiaries 2 or more generations younger than the donor grandkids, great-grandkids. It's there to catch wealth that might otherwise skip a generation's worth of estate tax. If you don't plan for these, honestly, they can take a massive bite out of a family's legacy.
And the materials highlight something really critical right now, time-sensitive even. We're currently in a period with historically high exemption amounts for these taxes, right? Gift, estate, GST.
That's the absolute key point for planning right now.
Yeah.
These high exemption amounts, the amount you can transfer during life or death without triggering those federal transfer taxes, are historically high.
But there's a catch, a deadline.
There is, a big one. These high levels came from the Tax Cuts and Jobs Act back in 2017. But that part was temporary. It's scheduled to expire January 1st, 2026. So just over a year away now. These high exemption levels are said to be drastically reduced. They basically revert to the 2017 levels, adjusted for inflation, but effectively, they'll be cut almost in half.
Wow. Okay, so for anyone with significant wealth, that creates a real, a limited window right now.
A very limited window.
If you have unused exemption, you can make large gifts now under these higher limits. But if you wait past the end of 2025...
you'll likely lose the ability to transfer that extra amount tax-free. It's very much a use it or lose it scenario for this specific high exemption level.
So leveraging that window is a major driver for a lot of the advanced planning happening now.
Absolutely. It's pushing a lot of activity. But, the sources are clear. Advanced planning isn't just about minimizing taxes. That's a big piece. But there are other core goals just as vital.
Like what?
Asset protection. Robust protection from potential creditors, lawsuits, maybe even unforeseen financial issues hitting future generations. You also want to maintain control where it makes sense and ensure assets are transferred exactly according to your wishes, your values, not dictated by probate courts or creditors or something else.
Right. It's like that three-legged stool.
Yeah.
Minimizing tax, protecting the assets, and then keeping control or directing the transfer.
That's a great way to put it. And hitting all three often means moving beyond the simple tools. Basic wills, revocable living trusts. They're essential foundations, yes, but for significant wealth, the level of control, protection, and tax efficiency needed often demands, more sophisticated strategies.
Okay, which brings us to some of the foundational building blocks. Trusts, specifically irrevocable trusts. That word irrevocable, it sounds so final, like you put assets in and that's it, no turning back. Why go that route?
Well, that perception of finality is exactly what gives them their power in this context. For estate planning, for asset protection, the whole point of an irrevocable trust is that once you, the creator, the settlor, transfer assets in, you give up significant control.
Dominion.
Because you don't technically own them anymore in the same way.
Precisely. The assets belong to the trust. And because of that, they can often be shielded from the creditors of the beneficiaries, the people receiving the benefit, who aren't the settlor. The assets are held for their benefit, not owned by them directly, at least until distributed. Okay, so it protects the wealth for the people you intend to benefit, insulating it from their potential money troubles down the road.
That's a key layer, yes. And building on that, you have specific types of trusts designed to really enhance this protection. They're known as spendthrift trusts.
Spendthrift sounds like they protect beneficiaries from themselves, almost.
In a way, yes. These trusts have specific language drafted in, designed to protect beneficiaries not just from outside creditors, but also from their own potential poor financial choices or habits. They can't easily waste the inheritance before they get it.
How does the legal language actually do that? What's the mechanism?
The core is the spendthrift provision itself. It's a clause in the trust document. It explicitly prohibits the beneficiaries from voluntarily transferring their interest, selling it, assigning it, using it as collateral for a loan. They can't pledge future trust distributions. And it also typically bars involuntary transfers, meaning creditors generally can't attach the beneficiary's interest in the trust. They can't levy against it, force a sale of it. The legal idea is the beneficiary's interest is locked inside the trust, can't be alienated, can't be reached by third parties until the money is actually paid out to the beneficiary.
That makes sense. You're trying to ensure the funds last, used for the intended purpose over time. Now, the sources mentioned different types based on who benefits relative to who creates it.
Right. You have the more traditional third-party trust, or TPT. This is the classic setup. A parent sets up a trust for their child or grandchild. The settlor creates it, funds it, but importantly, the settlor is not a beneficiary.
And that TPT structure, that generally offers strong protection for the beneficiary from their creditors.
Yes, typically very effective. The assets belong to the trust, not the beneficiary directly, and that spendthrift clause works well. The other type is the self-settled spendthrift trust, often called an asset protection trust, or APT.
Self-settled, meaning?
Meaning the creator, the settlor, is also named as one of the potential beneficiaries of the trust.
Okay, hold on. So you create a trust, put your own money in it, and then name yourself as someone who can benefit, hoping that protects those assets from your own creditors.
That is exactly the goal with a self-settled APT. However, and this is a really critical distinction, the sources hammer home the effectiveness of these self-settled APTs against the settlor's own creditors. That's where things get much, much more complex. It depends heavily on state law.
So it's not universally recognized.
Historically, many states just didn't recognize a spendthrift provision as valid against the creditors of the person who put the money in themselves. The logic was you shouldn't be able to shield your own assets from people you owe money to simply by putting them in a trust you could benefit from.
So setting one up might work in State A, but be useless in State B for protecting your own assets.
Precisely. Now, the sources do say the weight of authority does recognize these trusts as valid entities. But whether they actually protect the settlor's assets from the seller's creditors varies widely by state. And even in states where they are recognized, there's a huge caveat.
Which is?
Fraudulent transfer law, or voidable transactions, sometimes called.
Right.
Even if the state generally allows APTs, creditors can still potentially reach assets transferred into the trust if that transfer is deemed fraudulent or voidable.
Meaning you transferred the assets specifically to avoid paying creditors you knew about.
Exactly. Or if the transfer was made when you were already insolvent, or the transfer itself made you insolvent. You can't see a big lawsuit coming, quickly dump everything into an APT, and expect it to be untouchable. Timing and intent are absolutely critical.
Got it. So not a magic shield if you're already in trouble. The sources also bring up another key concept here related to funding these trusts. Completed versus incomplete gifts. Tax concept, right?
Yes, very important for gift tax purposes.
Yes.
What's the difference and why does it matter here?
So a completed gift for federal gift tax purposes happens when the person transferring the transfer gives up enough control, enough dominion over it. They can't change who benefits anymore, basically. Once that happens, it's a completed gift.
And that uses up part of your lifetime gift tax exemption?
Right. Or you pay gift tax if you've used up your exemption. And generally, those assets are then out of your taxable estate for estate tax purposes later on.
Okay, so what's an incomplete gift then?
That's where the settlor, the transferor, keeps certain powers. Powers substantial enough that the IRS says, nope, you haven't really let go yet. Maybe the power to revoke it or change the beneficiary is often without limits.
Yeah, and how does this relate to APTs?
Well, the source notes that historically, typical self-settled APTs were often structured as incomplete gift trusts, precisely because the settlor is a beneficiary and usually wants to keep some flexibility, some potential access, some power over distributions.
Ah. So because the settlor could still potentially benefit or control things, the gift wasn't seen as complete for tax purposes. The assets stayed in their taxable estate, even if the goal was creditor protection.
Exactly. Asset protection might have been the primary goal, but it didn't get the assets out of the estate for tax purposes. However, there's a more recent, more complex trend towards using what are called completed gift self-settled APTs.
Okay, now you're trying to have your cake and eat it too.
Kind of. These are for clients who look at the current high gift tax exemption and say, I want to use that now, lock in that tax benefit, make a completed gift, get these assets out of my estate.
But I still want to be a potential beneficiary for asset protection.
That's the objective.
Wow.
But these are incredibly complex structures. They have to be set up in one of the specific states, the sources list, about 20 domestically or offshore jurisdictions that actually permit self-settled trusts to be effective against the settlor's creditors.
And the drafting has to be perfect.
Meticulous, absolutely meticulous drafting and ongoing administration. You have to ensure the settlor hasn't kept any power or even had some kind of implied understanding that could let the IRS pull those assets back into their taxable estate later under those complex code sections 2036 to 2042. Those are the sections about retained interests or powers, right?
Exactly. Section 2036 pulls assets back if you kept the right to income or enjoyment, or the right to say who gets it. Section 2038 pulls them back if you kept the power to alter, amend, revoke, or terminate. For these completed gift APTs to work, the drafting has to be so tight that the settlor has zero legally enforceable rights or powers. They have to rely entirely on the independent trustee's discretion to maybe make a distribution to them someday.
So big potential upside using the exemption, getting protection, but also very high risk if it's not done flawlessly. Sounds like it's not for everyone.
Definitely not, and not suitable for every client's risk tolerance. Trusts, especially these irrevocable ones, they're clearly foundational, offering layers of protection, control over distributions.
Okay, trusts are definitely key building blocks. Now, what about strategies that let you shift significant wealth down the line for tax reasons, but maybe let the senior generation keep more direct, hands-on control over the actual assets?
Now you're talking about family limited partnerships, FLPs, and family LLCs. These become incredibly useful tools for exactly that scenario. An FLP is a well-established method. You can use it to transfer family assets, could be an operating business, real estate portfolio, stocks, bonds, whatever, to younger generations, tax efficiently.
And the key feature.
The senior members, usually the parents who set it up with the assets in, can keep significant control over those assets, over the entity's operations, even after they've transferred a large chunk of the economic value to their kids or grandkids.
How does the structure allow that balance of shifting value but keeping control?
Typically, the parents create the FLP under state law. They contribute assets to it. In return, they get partnership interests. But there are two classes, general partner interests, GP, and limited partner interests, LP.
And the parents are the GPs.
Right. The parents serve as the general partners. And crucially, they can hold a tiny percentage of the total equity as the GP interest, like 1% is common. The rest, say 99%, is the limited partner interest. Initially, the parents hold both the GP and all the LP interests.
And then the gifting begins, gifting the LP units.
Exactly. They start systematically gifting the limited partner units to the kids or grandkids over time. And they can use their annual gift tax exclusion for this.
That's the amount you can give each year per person without dipping into your big lifetime exemption.
Correct. The sources use the 2019 example, $15,000 per recipient. Since there are two parents, they can split gifts. So they could give $30,000 worth of LP units to each child each year without touching their lifetime applicable exclusion amount, the AEA.
And that AEA, that's the big number that's changing in 2026.
That's the one. It was $11.4 million per donor in 2019, now over $13.6 million in 2024. But yes, scheduled to drop significantly.
Can you walk through that first example from the source? Show how the annual exclusion gifting works here.
Sure. Imagine parents put a $1 million asset into an FLP. They take 1 per TP, 99% LP. They have 3 kids. Using their combined $30,000 annual exclusion per child, they give $30,000 worth of LP units to each. That's $90,000 total gifted per year. 30K by 3.
Okay.
Since the total value is $1 million, that $90,000 gift represents 9% of the entity's value,
Yeah.
90K $1, or just over 9% of the LP interest itself. At that rate, assuming values and inclusions stay the same, it takes them about 11 years
11 years.
to gift away the entire 99% LP interest to their children, completely gift tax-free, using only those annual exclusions.
And the really critical point, the control piece. Even after gifting away 99% of the economic value via those LP units, the parents holding just that 1% GP interest still have exclusive control. Management, operations, distributions, they decide everything.
That's a primary appeal for the senior generation, absolutely. They see the wealth moving, know it's protected in the partnership structure, but they haven't given up the reins on managing it. But the real tax power, as the sources really emphasize, comes from applying valuation discounts to those LP interests.
Valuation discounts. Okay, this sounds important. And like something the IRS might look at closely, why can you discount the value of an LP interest?
Oh, the IRS definitely looks closely. Yes. The reason you can discount them is that an LP interest is inherently less valuable than just owning a proportionate slice of the underlying assets directly. Think about owning a piece of real estate versus owning an LP unit in a partnership that owns the real estate.
Why less valuable?
Several reasons. LPs have basically zero control over management or assets. The GP calls all the shots. There are usually big restrictions on transferring the units. The partnership agreement often requires GP permission or gives others the right of first refusal. There are minority holders, can't force a sale or liquidation, and frankly, there's very low marketability. There's no public market to easily sell your LP interest in a private family partnership.
So because it's restricted, lacks control, isn't easy to sell. Its fair market value for gift tax purposes is lower than the simple pro rata share of the assets inside.
Exactly. The sources suggest these discounts can be significant, potentially 30%, 40%, even 50% or more, depending on the assets, the specific partnership agreement, market conditions.
And this discount lets the parents transfer more underlying value with the same gift exclusion amount.
That's the leverage. Let's revisit that second example from the source, applying the discount.
Okay, same facts. $1 million asset, 1% GP, 99% LP, 3 kids, $30,000 annual exclusion gift per child. Now add, say, a 30% discount.
Right. A 30% valuation discount means an LP interest with a face value of $1 is valued at only 0.70 cents for gift tax purposes. So to make a $30,000 gift for tax purposes, you have to transfer LP units that actually represent more of the underlying $1 million asset value. The math is $30,000 divided by 1 minus 0.30.
Which is $30,000 divided by 0.7.
Comes out to $42,857.
Wow. Okay, so a $30,000 annual exclusion gift with that 30% discount effectively transfers LP units representing almost $43,000 of the underlying asset value per child per year. That's serious leverage.
It is. For the 3 kids, they're gifting $90,000 total for gift tax purposes each year, 30K by 3, using only annual exclusions. But because of the discount, that $90,000 taxable gift represents LP units with a nominal value of about $120,571, $42,857 by 3 right. That's nearly 13% of the total $1 million asset value each year.
So instead of 11 years to gift it all away.
Now it takes only about 9 years, 99% LP, 13% gifted per year, to transfer the entire 99% LP interest using only annual exclusions. Big difference.
The discount really accelerates that tax-free transfer. And I assume this leverages the big lifetime AEA just as powerfully.
Absolutely. Using the 2019 numbers again, $11.4 million AEA per donor. With a 30% discount, that $11.4 million of taxable gift value lets you transfer LP units representing $16.28 million, 11.7 of underlying asset value.
Per person.
Per person. For a married couple, that's potentially over $32.5 million of underlying value transferred without gift tax just by leveraging those discounts. That's where the huge state tax savings potential lies for HNW individuals.
That's the power. But you mentioned the IRS is hostile to these. What does that practically mean?
It means they actively challenge them. They scrutinize the setup, the ongoing administration. They often argue the FLP lacks a valid business or investment purpose beyond just tax savings. They want to see real reasons, consolidating assets, succession planning, asset protection.
Yeah, just a tax trick.
Right. They might challenge if a real gift happened at formation. They might use Section 2036, arguing the parents kept too much control as GPs, so the assets should be pulled back into their estate anyway. And of course, they'll fight the amount of the discount. They'll bring their own valuation experts.
So having a solid, documented non-tax purpose and getting expert defensible valuations for those LP interests, absolutely critical.
Essential. The sources are clear. If these aren't set up and run meticulously, the tax benefits can be lost. The consequences can be very unfavorable.
Beyond the big tax benefits, estate tax reduction, leveraging exclusions with discounts, maybe even some income shifting, the sources list other advantages too, right? Non-tax benefits.
Yeah, they're quite versatile. Things like helping continue a family business across generations with centralized control, limiting individual owner liability, consolidating scattered family assets under one roof for easier management, pooling assets for bigger investment opportunities, simplifying estate administration later on.
Makes sense.
Also creating a framework for joint family management, maybe teaching younger generations about handling wealth, facilitating structured gifting over time, providing some asset protection from maybe irresponsible family members, and potentially reducing overall management costs.
Okay, that's a good overview of FLPs. The sources also cover family LLCs. How do they compare? Why pick an LLC instead?
Family LLCs are very similar in purpose and mechanics. They're hybrid entities. You get limited liability like a corporation, but pass-through tax like a partnership. Owners are members, not partners. Parents contribute assets, become managing members like GPs, and gift non-managing member interests like LPs to the kids.
Are there specific advantages LLCs might have over FLPs?
Yes. The sources point out a few key ones. One big one, limited liability for all members, including the managing members. In a typical limited partnership, only the LPs get that shield. The GP, often the parent, is still personally on the hook for partnership debts.
Ah, that's a significant difference.
It can be. LLCs also tend to offer more governance flexibility. Non-managing members, the kids, might be able to participate more and maybe have certain roles without losing their liability shield. That's harder for limited partners in an FLP. And LLCs might allow for a post-death, non-taxable liquidation in some cases.
So maybe a bit more flexible, broader liability protection for everyone.
That's the idea. The sources do note valuation discounts for LLCs might be slightly lower than FLPs sometimes, depending on the state's LLC laws, but they can be very similar in states with favorable statutes.
Okay.
And they offer that same potential for income shifting we saw with FLPs.
Right. As you gift the units, the income generated by the assets inside follows those units to the kids, potentially taxed at their lower rates.
Exactly. The source gives a really clear example of this. Scenario 1. Parents have high income, salary plus investments, pushes them into the top federal bracket, 37% in the example, and they owe the 3.8% net investment income tax, the NIT, on $300,000 of investment income. That's an $11,400 NIT bill.
Okay.
Scenario 2. They put a chunk of those income-producing assets into an FLP, keep 1% GP, and gift 33% of the LP interest to each of their 3 adult children. So 99% of the LP interest is gifted away.
And this moves the tax liability for that income.
It does. It shifts $99,000 of that net investment income to each of the 3 kids. $300 at NII, 99% LP, 33% each. The parents, holding just the 1% GP, are left with only $3,000 of that NII attributed to them.
So their total taxable income drops.
Dramatically. Their highest marginal rate falls to 24% in the example. Their NIT liability plummets from $11,400 down to just $114, 3.8% on the remaining 3K. The income shifted to the kids gets taxed at their rates, likely lower. Example uses 22% and 24%. And the kids in this example weren't subject to the NIT, so that extra tax layer disappears for that income.
That really shows how these structures aren't just about estate tax. They can have significant ongoing income tax benefits too.
It highlights the multi-layered potential, absolutely, when applied strategically.
Okay, let's shift gears a bit. Moving from structures mainly about wealth transfer and control, let's talk about strategies involving actually giving wealth away, specifically leveraging philanthropy, charitable giving. For HNW individuals, this isn't just altruism, right? It can be a core part of the tax and wealth plan.
Absolutely. Strategic charitable giving offers that great dual benefit. You support causes you really care about, and you can get significant tax advantages. We're talking potential reductions in current income tax, future estate tax, maybe even capital gains tax.
The sources list several key charitable vehicles used here. Let's tick through them and their main tax benefits.
Okay, first up, and very popular these days, donor advised funds, DAFs. You contribute cash, securities, other assets to a DAF account, which is sponsored by a public charity. You generally get an immediate income tax deduction for that contribution right in that year.
And the money sits in the JAF account.
Right. It can be invested potentially grow tax-free, and you retain the flexibility to recommend grants from that DAF to qualified charities whenever you choose. So you separate the timing of your tax deduction from the timing of the actual charitable grants.
Like a charitable savings account where you get the tax break up front.
That's a good analogy. Next, charitable remainder trusts, CRTs. This is an irrevocable trust. You transfer assets in, often highly appreciated assets. The trust then pays an income stream back to you, the donor, or maybe other non-charitable beneficiaries for a set term, like up to 20 years, or for your lifetime.
And when the term ends?
Whatever's left in the trust goes to the charity you designated.
What are the tax benefits of a CRT?
You get an upfront charitable income tax deduction in the year you fund it. It's based on the calculated present value of what's expected to go to charity eventually. And crucially, if you fund it with highly appreciated assets stock, real estate the trust can sell those assets without triggering immediate capital gains tax.
Ah, so the trust sells, not you.
Right. That gain gets deferred. You, the income beneficiary, only recognize pieces of that gain over time as you receive your income payments from the trust. Depends on the structure, annuity, or unit trust payout.
So CRTs seem really good if you have, say, appreciated stock you want to turn into income, but you don't want the huge immediate capital gains hit.
Exactly. Convert appreciated assets to income, get a current deduction, defer the gains. Now, the flip side of a CRT is a charitable lead trust, a CLT.
Lead trust, so the charity gets the income first.
Correct. With a CLT, the income stream from the trust goes to the charity for a set term. At the end of that term, whatever assets remain pass to your non-charitable beneficiaries, typically your family.
How does that help with wealth transfer taxes?
A CLT can reduce the value of the assets ultimately passing to your family for gift or estate tax purposes. The value of that income stream, promised to charity, reduces the taxable value of the remainder interest going to your heirs. It is often used by folks with larger estates who want to benefit charity for a while and then pass the rest to family with lower transfer tax cost.
The sources also mention QCDs, qualified charitable distributions.
Yes, very valuable tool for people 70 and a half or older. You can direct transfers straight from your IRA to a qualified public charity. The big benefit: these QCDs count towards satisfying your required minimum distributions, your RMDs.
But the amount transferred doesn't get included in your taxable income.
Exactly. You meet your RMD obligation without boosting your adjusted growth income. That can be much better than taking the RMD as income, paying tax on it, and then making a separate charitable gift, which might face deduction limits.
Makes sense. What about charitable gift annuities, CGAs?
This is where you make a gift and get a fixed payment back for life.
Right. It's a contract with a charity. You give them cash or assets. In return, they promise to pay you a fixed annuity payment for life or maybe joint lives. You get an immediate charitable deduction for part of the gift value.
The part the charity expects to keep eventually.
Correct. And you secure a reliable income stream for life. Part of each payment might even be a tax-free return of your principal for a while. A gift now for guaranteed income later. And then private foundations. These seem like a bigger undertaking.
They are. Private foundations are for individuals or families wanting a significant, lasting philanthropic legacy, where they keep direct control over grant-making and investments. You set up a separate legal entity, contribute assets, get charitable deductions, though with slightly different rules than public charity gifts.
And you can avoid capital gains on donated appreciated assets.
Yes, similar to CRTs in that respect. The trade-off is complexity, substantial admin, regulations, compliance costs, usually for people planning major long-term philanthropy.
The sources really emphasize donating appreciated securities directly.
Yes, this is one of the most common, most impactful strategies. If you donate stock, bonds, mutual funds you've held over a year, and they've gone up a lot in value, you generally get a deduction for the full fair market value on the donation date.
And the crucial part:
you completely avoid paying the capital gains tax you would have paid if you'd sold the securities first and then donated the cash.
So full value deduction, plus you bypass the capital gains hit. That makes the gift bigger for the charity at a lower after-tax cost to you.
Exactly. It's a win-win. The sources also mention donating complex assets, real estate, art, private business interests. These can also generate big deductions and avoid capital gains, but they're way more complex. Appraisals, rules, potential limits definitely need expert help there.
And finally, planned giving, integrating charity into the estate plan itself.
Right. Naming a charity in your will a bequest. Designating a charity as beneficiary of a retirement account. Setting up charitable trusts that kick in at death. Ensures lasting support for causes you care about and can provide a valuable estate tax deduction, lowering the taxable value of your estate.
It's clear strategic charitable giving is a powerful tool, a blend of doing good and significant financial benefits. And, as the sources say, the best strategy really depends on the individual.
Absolutely. Highly personal, driven by both philanthropic desires and financial realities.
Okay, let's circle back to trusts, but dig into some even more advanced strategies. Ones that maybe leverage those current high exemptions, or find alternatives if exemptions are already used, often while boosting asset protection too.
Right. A really popular strategy right now, specifically because of the high exemptions, is the Spousal Lifetime Access Trust, or SLA.
SLT. Okay, how does that work?
It's an irrevocable trust. One spouse, the donor spouse, makes a gift of assets into the trust. The primary beneficiary is the other spouse, the beneficiary spouse. The donor uses their own lifetime gift tax exemption for this transfer.
So the assets plus future growth are removed from the donor spouse's taxable estate.
Correct. That's the primary goal, using the exemption now.
And the beneficiary spouse can potentially access those funds.
Yes. The trust is drafted, so the independent trustee has discretion to make distributions to the beneficiary spouse, often for things like health, education, maintenance, support the HIM standard or other defined needs. The appeal is clear. You move wealth out of the combined marital estate using one spouse's exemption, but the assets remain kind of indirectly available to the family unit through distributions to the other spouse.
And then after the beneficiary spouse passes away?
Typically, the remaining trust assets pass down to the next generation, free of estate tax in either spouse's estate.
Sounds great. But the sources flagged a major pitfall if both spouses try to do this for each other. You can't just set up identical trusts.
Exactly. That's the reciprocal trust doctrine. If spouses create very similar slats for each other around the same time, substantially same terms, the IRS and courts can basically uncross them. They'll treat each spouse as if they created the trust they are the beneficiary of.
Which totally undoes the benefits, right?
Precisely. If you're treated as the settler of a trust you can benefit from, those assets can get pulled right back into your own taxable estate under rules like 2036. Undermines asset protection too. So the sources stress, to avoid this doctrine, that the two slats must be materially different.
How different is different enough? What makes them materially different?
Usually involves significant differences in the terms. Maybe different beneficiaries, one includes kids right away, the other only after the spouse dies. Different distribution standards, HEMS versus broader discretion. Different trustees, maybe even fund them with different types of assets. You need real, demonstrable, non-tax reasons for the differences. And there's that fascinating point in the sources about how specific state laws can interact with slats, maybe giving even more flexibility, addressing that giving up access concern for the donor spouse.
You mean like that Arizona example they gave?
Yes, perfect illustration. Arizona law generally doesn't recognize self-settled APTs against the settler's creditors. But under specific statutes, like the one cited 1410505E, if the beneficiary spouse, let's call her spouse B, is given a certain power in the slat spouse A set up for her. Specifically, a testamentary limited power of appointment.
Meaning she can say where the assets go at her death, but only among a limited group.
Exactly. Excludes her estate, her creditors. Spouse B could potentially use that power to direct the assets into a new trust created for the benefit of the original donor spouse, spouse A.
Whoa. So even in a state that doesn't normally let you protect your own assets in a trust you benefit from, this slat structure plus a specific state law plus that power of appointment means the original donor spouse, spouse A, could potentially benefit down the road after spouse B dies.
Correct. According to the source, that specific statutory exception allows it. It effectively creates a kind of de facto self-settled trust situation for spouse A, just with delayed access and relying on spouse B actually exercising that power.
That's really nuanced.
It is. And the sources list other states with similar statutes: Arkansas, Florida, Georgia, Mississippi, North Carolina, Oregon, South Carolina, Tennessee, Texas, Virginia, Wisconsin. The implication: if your state isn't favorable for this kind of contingency, maybe consider changing the trust's location, its situs, to one of these states.
Wow. Shows how critical state-specific law is in advanced planning. You can't just use a generic template.
Absolutely underscores that. Now, the sources also circled back to those completed gift self-settled trusts we touched on earlier.
Right, the ones for clients who want to use the big exemption now but are really nervous about giving up access completely.
Exactly. Trying to get the completed gift for tax purposes, get assets out of the estate, but still remain a potential beneficiary for protection and maybe access. As we said, they must be in one of those specific states that allow self-settled trusts against settlers' creditors.
And the big risk is still those IRC sections 2036 to 2042, pulling the assets back into the estate.
That's the main tax risk. Requires incredibly meticulous drafting, ongoing administration. Ensure the settler retains no binding right or power, explicit or implicit. Access has to be purely at the independent trustee's discretion. They're complex, carry significant drafting and audit risk, need highly experienced counsel.
So definitely not standard, more risk involved. What about trusts designed specifically for income tax planning? Maybe using that intentionally defective idea.
Yes, the intentionally defective irrevocable trust, the IDIT, another common third-party trust, usually for kids or grandkids. It's called intentionally defective because it's deliberately drafted to make the settler treated as the owner of the trust assets, but only for income tax purposes under the grantor trust rules, section 671, 677.
Wait, intentionally making the settler pay income taxes on assets they already gifted away for estate tax purposes? Why do that? Still sounds backwards.
The benefit is actually pretty significant. When the settler pays the income taxes generated by the trust ordinary income, capital gains, they are effectively making an additional tax-free gift to the trust each year, equal to the amount of taxes they paid.
So the trust assets grow faster because the trust itself isn't paying the income tax.
Exactly. The trust assets compound free of that internal income tax drag. It preserves more capital inside the trust for the beneficiaries. And it further reduces the settler's own taxable estate, because they're using their personal funds to pay the tax liability generated by assets that are already outside their estate for gift and estate tax purposes.
That's clever. A way to push more value down without using more gift exemption. How do you actually make a trust defective like that? Trigger those grantor trust rules.
The sources mention a couple of common ways. One is giving someone, maybe acting personally, not as a trustee, the power to swap or substitute assets of equivalent value between their own funds and the trust. Another is giving the settler, or someone who isn't adverse, the power to let the settler borrow from the trust without adequate interest or security. Either of those retained powers can make the settler the owner for income tax. The sources also bring up business opportunity trusts, BOTs, sometimes called Section 678 trusts in this context.
Business opportunity sounds like it's for specific assets or businesses.
The goal, as described, is to let a beneficiary, usually the next generation, transfer an appreciating asset into the trust without triggering immediate income tax, and, critically, remove the future appreciation of that asset from their own estate without using their gift tax exemption. It uses a third-party trust structure, but one where the beneficiary's powers over the trust cause them, not the original settler, to be treated as the owner for income tax purposes under Section 678.
So the beneficiary steps into the grantor's shoes just for income tax for this trust.
That's the effect. Section 678 says if someone other than the grantor has the power to take the trust principal or income for themselves, they're treated as the owner for income tax. So if a beneficiary has certain powers, like withdrawing principal or directing distributions, that can trigger 678.
Okay. How does that let them transfer an asset in without immediate tax?
Because the beneficiary is treated as the owner of the trust for income tax, when that beneficiary sells an appreciating asset they own personally, like maybe valuable startup stock to the BOT,
right,
the IRS views that sale as the beneficiary selling the asset to themselves.
And selling something to yourself isn't a taxable event.
Correct. Sales between a person and their grantor trust, or a trust they're treated as owning under 678, are generally disregarded for income tax. So no capital gains tax triggered right then on the appreciation. The asset is now in the trust, future growth happens outside the beneficiary's personal estate, and they didn't use their gift exemption because it's structured as a sale, not a gift.
That sounds incredibly powerful, especially for, say, founders with rapidly appreciating private stock. Move future growth out of your estate, tax-free, no gift exemption used.
It's a very effective technique for those specific situations, high-growth assets. But the sources note a potential trade-off, asset protection.
How so?
The very powers the beneficiary has over the trust, the ones that trigger Section 678. They might weaken the asset protection compared to a standard third-party spendthrift trust, where the beneficiary has zero control or withdrawal rights, especially in states with specific asset protection trust laws. It's a balance. Finally, on income tax, the sources mention trust designed mainly for state income tax reduction, known by acronyms like NNDs, WINGs, DINGs.
Based on the names, Nevada, Wyoming, Delaware, states with no income tax.
You got it. Nevada, Wyoming, Delaware, Alaska, South Dakota, others mentioned. Key feature, no state income tax. And some also allow self-settled APTs. The strategy is to set up a trust in one of these states and structure it specifically as a non-grantor trust for income tax purposes.
So unlike the IDIT where the settler pays, here the trust itself pays the income tax.
Exactly. And because the trust's legal home, its administration, is in a state with no state income tax, the trust avoids state income tax liability on its accumulated earnings, interest, dividends, capital gains. It effectively shifts the state income tax burden from wherever the settler or beneficiaries live, maybe a high-tax state, to the zero-tax state where the trust is.
Sounds like a clear win if you live in California or New York.
It can be a tool for multi-state planning. But there's an important caveat mentioned. Trusts pay federal income tax at much more compressed rates than individuals. They hit the top federal bracket much faster.
Right, like at only $15,000 or so of income?
Exactly. Around $15,200 for 2024 hits the top 37% bracket. An individual doesn't hit that until over $600,000. So while you save state tax, you have to weigh that against the trust potentially paying higher federal tax if it accumulates a lot of income instead of distributing it. It's a calculation. Depends on income level, state rates.
Fascinating how state law differences are leveraged. Okay, let's focus now on strategies really targeting assets expected to appreciate significantly.
Grantor retained annuity trusts, GRNs. Prime example. It's an irrevocable trust. Grantor transfers assets in for a fixed term, 2, 5, 10 years, whatever. In return, the grantor gets fixed annual annuity payments back from the trust for that same term.
Put assets in, get fixed payments back. What's the tax goal?
Transferring the future appreciation, tax-free. The annuity payments are calculated based on the initial value put in and an IRS set interest rate, the Section 7520 rate. The idea is the annuity payments effectively give the grantor back their initial principal plus that assumed 7520 rate growth, any actual growth of the assets inside the GR, above that 7520 rate that passes to the remainder beneficiaries, kids, grandkids, at the end of the term. Completely tax-free. Uses minimal or zero gift tax exemption.
So you freeze the value for gift tax, and any growth above the IRS rate bypasses transfer tax.
Exactly. And a common technique, blessed by the Walton court case, is the zeroed-out GRAT. You set the annuity payment high enough so its present value almost equals the initial gift value. Result: tiny or zero taxable gift when you create it. You're basically betting the assets will outperform the 7520 rate.
That sounds perfect for assets expected to boom, like pre-IPO stock. The sources mention Zuckerberg and Facebook stock.
Classic use case. If that stock explodes during the GRAT term, all that massive growth goes to the next generation outside the estate and gift tax system.
Powerful. But risks. There are always risks.
Yes, main one. Mortality. If the grantor dies before the GRAT term ends, a chunk, maybe all, of the trust assets gets pulled back into the grantor's estate under Section 20 and 36A, estate tax benefit lost.
So shorter terms are often better. Less chance of dying during the term.
Often, yes. Minimizes mortality risk. The other risk is performance. If the assets don't beat the 7520 rate or even lose value, the strategy fails. Nothing extra passes to the beneficiaries. The grantor just gets their annuity payments back.
And the 7520 rate itself matters. Lower rates make it easier to beat, improving the odds.
Correct. The interest rate environment definitely affects how attractive GRs are.
Okay. Another asset-specific strategy, qualified personal residence trusts, QPRTs, for homes.
Exactly. QPRTs are specifically for transferring a primary residence or a vacation home. Grantor transfers the house title to an irrevocable trust for a fixed term, say 10, 15 years. Key is they retain the right to live in the home rent-free during that term.
So you gift your house away but keep living in it.
For the chosen term, yes. And the taxable gift you make when you create the QPRT isn't the home's full value. It's the discounted value of the remainder interest, what passes to the beneficiaries after your right to live there ends. Calculated using that 7520 rate again. Since you keep the right to live there for years, that retained value is subtracted, making the taxable gift much lower.
So you use way less lifetime gift exemption to transfer a valuable house.
Precisely. Benefits. Lower taxable gift, preserves exemption. You keep living there rent-free during the term, and you remove the home's future appreciation from your estate if you survive the term.
Okay, if you survive the term. So mortality risk again.
Same as the jurat. If the grantor dies during the QPRT term, the full home value gets pulled back into the estate under 2036A. Estate tax benefit gone. Term choice based on health, life expectancy is key.
What else? Any other pitfalls?
A big one, highlighted in the sources, is what happens after the term ends. You lose the legal right to live there rent-free.
Right.
To avoid the IRS arguing you still have enjoyment and pulling it back into your estate anyway, like in the estate of Maxwell case mentioned,
Yeah.
you have two choices. Move out or...
Pay rent.
Exactly. Enter into a bona fide lease agreement with the beneficiaries or a continuing trust holding the house and pay fair market rent.
And that lease has to be real at market rates, not just a token payment.
Absolutely critical. Genuine lease, fair market rent, properly documented. Sources stress this point heavily. Another drawback. Beneficiaries get the house with your original cost basis. No step up at death. So they might face big capital gains if they sell it later. And QPRTs are only for personal residences, not rental properties.
So QPRTs are best for someone with a valuable home, reasonably sure they'll outlive the term, wants to cut future estate tax on that specific asset, and is okay with potentially paying rent later.
That sums it up well. Very specific tool for a specific asset within a larger plan.
We've touched on asset protection all along, but let's focus on it as a core pillar.
Yes, the sources really emphasize this. Planning isn't just taxes. It's fundamentally about safeguarding the wealth, the legacy from all sorts of challenges. Creditors, lawsuits, business, personal, professional, other unforeseen financial or legal issues.
And those asset protection trusts, the self-settled ones, are a core tool, but with all those state-by-state differences we discussed.
They are, whether domestic and permissive states or offshore. We talked about the completing gift trend, partly for exemption use. But the actual protection, especially against the settler's own creditors, hinges heavily on the specific jurisdiction's laws. And, crucially, avoiding that fraudulent transfer issue.
Beyond the trust itself, the sources mention layering protection. What does that look like?
Using multiple structures together, like holding assets, maybe real estate or investments, inside entities like family LLCs or LPs first. That adds a layer. If a creditor comes after an owner personally, they might only get a charging order against the owner's interest in the entity.
And a charging order isn't as good as seizing the asset itself.
Generally, no. It usually just entitles the creditor to receive distributions if and when the entity makes them. If the managers, like the parents in an FLP, control distributions and decide not to make any, that charging order might not yield much for the creditor. Makes the interest less attractive.
So the entity acts as a buffer and leveraging state law protections.
Vital. Using state-specific creditor protections, like homestead exemptions protecting home equity, amounts vary wildly, or exemptions for retirement accounts, life insurance cash value. A good plan identifies and uses these state safe harbors. The bottom line from the sources: asset protection is highly individualized, no single answer, tailored based on risk profile, business, personal situation, comfort with complexity, willingness to give up some control, often necessary for best protection, state of residence, where assets are.
It sounds like it's not just an option, but a fundamental part of any serious estate plan for significant wealth.
It absolutely should be. Protecting what's built is foundational to preserving it.
Okay, let's add another layer of complexity. What happens when families aren't just in one place? They move, become international, global dynamics, dynasty trusts come into play here.
Yes, dynasty trusts. Designed to last for multiple generations, potentially avoiding transfer taxes, estate, gift, GST, on the assets inside as they pass down the line. Huge benefits: long-term income tax planning, estate tax avoidance for decades, creditor protection for generations, ensuring assets follow the family line as intended.
The ultimate multi-generational tool, sounds like.
Can be incredibly powerful.
Yeah.
But, as the sources say, the dynasty is in the details. Big challenges pop up, often unexpectedly, when family members or even trustees or advisors move internationally.
How does someone moving outside the U.S. affect a U.S. trust?
This gets into the critical difference between a U.S. domestic trust and a foreign trust for U.S. income tax purposes. A trust is domestic only if it meets both or two tests: the court test and the control test.
Court test, control test.
Court test. A U.S. court must be able to exercise primary supervision over the trust administration. Control test. One or more U.S. persons must have authority to control all substantial decisions of the trust.
So if it fails either test, even if set up in the U.S., it becomes a foreign trust for income tax.
Exactly. And substantial decisions is broad. The sources list examples: deciding distributions, when, how much, picking beneficiaries, allocating between income and principal, terminating the trust, handling lawsuits, removing or appointing trustees, even investment decisions if a foreign advisor controls them.
Meaning, if you name a successor trustee who isn't a U.S. person, or a beneficiary with power over decisions moves abroad and keeps that power, that could accidentally flip your U.S. trust into foreign status.
Precisely. The example used. Jane has power to replace a U.S. trustee with a non-U.S. person for John's trust. If she does, and that non-U.S. trustee controls substantial decisions, boom, foreign trust, triggering potentially adverse tax consequences in reporting.
What kind of adverse consequences?
Things like the throwback rules on accumulated income could cause old income tax at low trust rates to be taxed again at the beneficiary's current high rates, plus interest when distributed, and significant extra reporting. Forms 30520, 3520, 3520AA. Big penalties for messing those up.
So not just a label change, real tax and admin pain. What happens tax-wise at the moment a U.S. trust becomes foreign? A migration.
Sources bring up IRC Section 684, generally requires gain recognition on appreciated property when a U.S. person transfers it to a foreign trust. A migration is treated similarly.
How does 684 apply on migration?
Depends on who the grantor and beneficiaries are after migration. If it's still a U.S. grantor trust with U.S. beneficiaries, under Section 679, which treats U.S. grantors as owners of foreign trusts with U.S. beneficiaries, then the 684 gain recognition is postponed until it stops being a grantor trust. Grantor dies, no more U.S. beneficiaries, then the gain hits.
Okay. What if it's not a grantor trust after migration?
If there's no U.S. grantor or no U.S. beneficiaries at migration, then Section 679 doesn't apply. The general 684 rule hits immediately. The trust itself recognizes gain on all its appreciated assets, as if sold right before becoming foreign.
Ouch. This really screams get professional advice if anyone involved might move internationally.
Absolutely. Sources suggest proactive drafting, allow trustees to change situs in governing law, but mandate they consult a U.S. tax advisor first to understand the 684-679 impact. And beneficiary residency matters too, even if the trust stays domestic. A U.S. beneficiary moves abroad. Their new country has its own tax rules for trust distributions, its own reporting, need advisors in both countries. Expatriation renouncing U.S. citizenship adds even more complexity, especially regarding trust interests.
So even a well-drafted U.S. dynasty trust isn't set it and forget it if the family goes global.
Needs active management, cross-border expertise. Now, the sources also cover the flip side. Non-resident, non-citizens, NRNCS gifting to U.S. beneficiaries.
How are U.S. gift and estate taxes different for them?
For U.S. transfer taxes, it's about domicile, not just income tax residency. A non-resident isn't domiciled here. Unlike some countries, the U.S. usually taxes the NRNC donor or their estate, not the U.S. recipient.
And what U.S. assets trigger U.S. tax for an NRNC?
This is key. For U.S. gift tax, an NRNC is only taxed on gifts of U.S. tangible personal property, art, jewelry physically here, and U.S. real estate. Critically, gifts of intangibles like U.S. stocks, U.S. bonds are not subject to U.S. gift tax for an NRNC.
But for estate tax?
That's different. For U.S. estate tax at the NRNC's death, those same intangibles are subject to U.S. estate tax if located here.
Huge difference. Intangibles escape U.S. gift tax for NRNCs, but not U.S. estate tax.
That difference creates planning opportunities. Sources suggest an NRNC can use a U.S. domestic non-grantor dynasty trust effectively for their U.S. beneficiaries. They can fund it by gifting assets that avoid U.S. gift tax, those intangibles, like bonds or maybe stock in non-U.S. companies.
So the initial funding is U.S. gift tax-free?
Correct. And if structured right as a non-grantor trust, funded with these non-gift taxable assets during the NRNC's life, the assets and future growth are out of the NRNC's U.S. estate too. Plus, potentially avoids GST tax for future generations with proper planning.
So an NRNC can set up a long-term U.S. trust for family using assets not caught by U.S. gift tax, potentially avoiding future U.S. transfer taxes too.
That's the strategy, leveraging that specific carve-out for intangibles in the NRNC gift tax rules. Of course, they might have taxes in their home country. And the U.S. trust and beneficiaries have U.S. reporting, like Form 3520 for gifts from non-U.S. persons. Still complex?
Clearly, even with global families, tools exist, but the details, absolutely critical.
A dynasty is in the details, especially when crossing borders, for sure.
Okay, we hit a lot of individual strategies, trusts, entities, charity. The sources wrap up with a case study showing how these pieces fit together in an integrated plan for a specific family.
Right, this case study. Married couple, Arizona residents, 2 kids, $25 million net worth. They see that 2026 exemption drop coming. Know they'll face estate tax if they do nothing. They also have a $1 million startup investment they think will really take off. And they're high profile, worried about asset protection.
What are their specific goals and constraints?
They want to use their exemption before it shrinks. But they don't want to gift away everything, need liquidity. Specifically, they figure they need $5 million protected, but potentially accessible somehow. And they need to keep about $3 million personally liquid, for solvency.
Very typical H&W balancing act.
Yeah.
Transfer wealth, protect it, keep enough cash on hand. How does the proposed plan tackle this?
It's multi-step, layered. Step 1, address the high-growth asset, that $1 Airman startup investment. Plans suggest putting it into a great, maybe a 5-year term. Fund it with enough cash, too, to cover the annuity payments until the expected IPO. Right. Use the great to remove that expected future appreciation from their estates, using little or no gift exemption up front. If the stock pops like they hope, that growth goes tax-free to the kids at the end.
Makes sense. Use the right tool for the rapidly appreciating asset. What about the $5 million they want protected but maybe need access to?
Step 2, focuses on that $5 protected nest egg. Plan suggests an offshore, self-settled asset protection trust for this amount. Primary goal, robust creditor protection. Using an offshore jurisdiction known for strong APT laws aims for better insulation than might be possible domestically.
And crucially, they keep the $3 million personally.
Absolutely critical. Plan explicitly says retain $3 million personally and assure solvency, cover near-term needs. That offshore APT money is for protection, a last resort, access discretionary with the trustee anyway.
So, solvency first. Don't lock up all liquidity. Now, how do they use that big unused gift exemption before the deadline?
Step 3, uses SLAT spousal lifetime access trusts. Plan suggests funding SLATs with the remaining $16 million, 25 M to total, 1 meter crafter, 5 short APT, 3 Melmers retained to $16 Ems. Each spouse sets up a SLAT for the other. Uses up a big chunk of their combined exemption, $16.
Designed carefully to avoid the reciprocal trust problem.
Yes. Different terms, trustees, etc. Set up to benefit the beneficiary spouse during life, providing potential access if needed, though likely intended as secondary funds to maximize tax benefits. Then, after the beneficiary spouse dies, they become dynasty trusts for the kids and future generations, free of future estate tax.
And being Arizona residents helps with the SLATs, that state law thing.
Exactly. Plan notes leveraging Arizona law. The SLATs can give the beneficiary spouse that limited power of appointment, allowing them to potentially direct assets at their death into a new trust that could benefit the original donor spouse. Uses that Arizona statutory exception, gives flexibility later if needed, while still using the exemption now.
This case study really pulls it all together. Great for growth, offshore ATT for protection access, SLATs for exemption use, and spousal flexibility. All layered, considering state law, prioritizing liquidity.
Great illustration of integration. The plan also includes a contingency. If the exemption drops unexpectedly early or looks like it won't be made permanent, they could consider converting that offshore APT to a completed gift trust, if state law allows and counsel advises, to use more exemption.
So the outcome. Minimized estate tax potential, strong layered asset protection, flexibility for change, and potential future access, all built on ensuring solvency.
Shows the level of customization and strategic thinking needed at this level.
We've said it before, but worth hammering home. The IRS knows about these complex strategies. They challenge them.
They do. Sources are explicit. Persistent IRS scrutiny, especially in valuation discounts, structures they think lack real economic substance beyond tax avoidance. They challenge the gift itself, use Section 2036 on control, dispute the discount amounts.
And getting it wrong is costly.
Very, sources warn. Incorrect setup, lack of documented purpose, sloppy administration. The intended tax and protection benefits can evaporate. Can lead to unexpected taxes, assets exposed. Consequences can be very unfavorable.
Which just underscores the absolute need for experienced experts. Legal, financial.
Indispensable. Experienced estate planning attorneys, tax advisors, maybe valuation experts, not just for the initial complex design, but for ongoing administration, compliance, annual revaluations for FLPS LLCs, navigating changes in law or family situation. Dealing with QPRT, post-term rent, or beneficiary moves for dynasty trusts requires proactive expert guidance. For years. Decades even.
Definitely not a DIY project.
Not if you want it to hold up, not over the long term.
Wow. Okay, that was truly a deep dive. Some incredibly sophisticated U.S. tax planning strategies for high net worth individuals. We went from the urgency around the exemption change through all kinds of trusts, LATs, IDITs, BOTs, APTs, family entities like FLPs, LLCs, valuation discounts, strategic charity via DMAFs, CRTs, asset-specific tools like GRETs, QPRTs, layered asset protection, and even global family dynamics with dynasty trusts and NRNC planning.
It really highlights how complex and multifaceted this planning is. It demands understanding a wide array of tools, how they interact, balancing tax, protection, control all at once.
The core message seems clear. For those with significant wealth, yes, powerful tools exist. You can significantly cut potential transfer taxes, protect assets, ensure wealth passes according to your goals. But These tools need careful selection, meticulous setup, diligent ongoing administration, often facing IRS scrutiny and changing laws.
And that looming 2026 exemption drop really does create a near-term push, a reason for action for many with unused exemption who want to lock in these current high levels.
Right, that window is key right now. So, for you listening, what stands out from all this? Do any of these approaches resonate with your own goals? Preserving legacy, protecting assets, making sure your wealth has the impact you intend? It's more than just tax avoidance. It's about intentionally shaping the future.
Which brings up a final thought. Given all this complexity, the reliance on specific laws, the potential for change in taxes or family situations over decades, how do you ensure a plan put in place today stays robust, stays effective, adaptable, secures that legacy for generations instead of just becoming, well, a static document that doesn't fit reality anymore?
What's the single most important step you might take next? Knowing what you know now about these advanced tools and the complexities involved in making them truly work over the long haul.